Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only. Hey everybody, so I wanted to do a video on skew and fixed strike vol. So I think some of you who like to get deeper into the volatility space might enjoy some of this. And I think it's kind of important for everybody to know, because these are all those little small nuances that can help us to make better decisions, and at the very least sort of understand a little bit more about behavior and what's going on out there, at least in the volatility world, and how it relates to what stocks are doing. Sometimes one can give you an indication that something is about to happen. And so here's your skew. Basically, this is your index skew. It looks like a smirk. Sometimes stocks will be more of a smile, which is that steep put upside and that steep call upside. But in index, mostly, certainly in the S&P, you get this steeper downside because people are buying protection, and you get that inverted upside call skew because it's a supply-driven side of the curve where people are selling calls all the time. And there are other reasons as well that we don't have to get into today, but this is the shape of the curve here. So one of the interesting things is everybody watches the VIX these days. And one thing to note is that let me draw a little arrow here to help me show this. Okay, so as let's say the market's trading right here, right? This is the at the money strike. This is the at the money volatility. So the out of the money volatility on the put side is higher, and the out of the money volatility on the call side is lower. Although down here, it usually starts to head up again with those really small, way out of the money calls. So when the market starts to drop a little bit, what does it do? The market drops and we go this way, right? So the market's going down. And what happens is you can see that we're riding up the skew a little bit, right? Because those out of the monies trade at a higher implied volatility, and it takes volatility usually under calm circumstances. It doesn't do much. Those strikes will kind of stay where they are until things settle down a little bit, and that becomes an at the money. But for now, you can see that as the market goes down, what's happening? The market is going into higher levels of implied volatility because those out of the money puts were trading at this difference in implied volatility from the at the monies. And so now the market is sitting at higher levels of implied volatility. So the VIX has gone up, right? From here to here, the VIX has gone up. But what have we really done? You might interpret that as, oh, the VIX is going up. People are getting nervous. People are buying options. They're buying protection. But the fact is that all that
Hey
might
everyone,
be
if you
happening
haven't
is we're
subscribed to the
riding
channel,
up
please
the
do,
curve.
and be sure to download my
Right?
free
We're
Options
riding up
Cash
the
Flow
curve.
Blueprint, a
Now, if
step-by-step
the market
guide
goes
for
down
how to
this
go from
much, you're going to
complete
see
beginner
something that I'm
to
going to show you in a
Options
moment.
Ninja.
But
Now
as
back
we
to the
kind
video.
of meander around, we're going to be reflecting the implied volatility of the VIX is going to be reflecting the curve to some extent, right? So take a look. Here we're riding up the curve, so the VIX is going up. Here we're riding down the curve as the market goes up. So we're moving into where cheaper implied volatility exists, right? Because yesterday, this is where cheaper implied volatility existed for these out of the money calls. And now the market is moving into that cheaper implied volatility. So what has happened? Well, the VIX has gone down. So the VIX goes up, the VIX goes down, but it isn't really doing anything, right? It's not like people are really reaching for protection. It's just reflecting movement along the curve. So I want to show you how this looks a little bit. So I'm going to show you some recent movement, and this is going to be from March 12th to the 13th. So what's happened here is the market has gone down. We were trading kind of around here, and we're moving down, right? This is where the skew is, the volatility skew. So this market is just riding down, and so the VIX is going up. But it's just riding the curve, right? The curve over the 2 days hasn't done anything. It's basically stayed the same, right? So you can kind of see that, in fact, it's actually dropped a little bit. And these were days where from the 12th of March to the 13th, the market actually dropped. But what happened? The curve actually dropped a tiny little bit. So even though the market went down, the volatility space was exhibiting a great deal of comfort on that day. It wasn't panicky. I'm going to show you panicky in a moment, but basically all the market was doing was riding down. And so we saw the VIX just kind of pop up, but then it kind of relaxed. So it didn't really do anything that day.
Hey everyone, if you haven't subscribed to the channel, please do, and be sure to download my free Options Cash Flow Blueprint, a step-by-step guide for how to go from complete beginner to options ninja. Now back to the video.
Because it sort of relaxed a little bit. The curve shifted slightly down. Now let me show you what that looks like in terms of the fixed strike. Fixed strike is where those out of the money puts are, right? So when we look at things, we can kind of look at what did volatility do as we rode down the curve. Well, it looked like it went up. But did it really go up? Fixed strike didn't do anything. But in this case, fixed strike actually went down. So we can see that even though the market was down from the 12th to the 13th, fixed strike volatility went down. That means those out of the money puts actually dropped. The implied volatility dropped a little bit on those out of the money puts, which is unusual, right? If in a nervous market, as the market goes down a little bit, it not only rides up the implied volatility curve, but it generally, that curve starts to get a little bit more panicky. Let me show you what that looks like on a day where it does in fact panic. So here we go from April 2nd to April 4th. Now we had a very big drop in the market from on those days. Here's April 2nd to April 4th. So we had a very big drop in markets, a very big drop. Let's see what happened in the skew space. Well, this was April 2nd in the yellow, which was sort of more of a typical skew. And here is April 4th. So what happened? We didn't just ride down the curve, which would have meant we moved from a lower level of implied volatility to a higher level. That would have been good enough for the VIX, right? The VIX would have technically reflected higher levels because of that. But it was such a big, strong move that the curve actually shifted up. The entire curve shifted up. Look at the calls went up, the puts went up. In fact, the calls went up even more than the puts in a sense. So we had this entire curve shift up. Where do we see that? In fixed strike, right? Fixed strike, those downside puts exploded in value. So not only did we ride down the existing curve, the skew was going to show us, the VIX went up because we were going down, but the VIX exploded also because fixed strike exploded. These way out of the money puts really, really steepened, right? So these started to fly up there, and you can see that in a shifting up of the curve. So the point I wanted to make today is sometimes we're just going to ride down the curve a little bit. And that's not going to get VIX too super excited. Although we're going to see the VIX go up, it's not really that excited. All we've done is we've moved to lower strikes on the SPY and the SPX. And those strikes were at a higher vol yesterday. So we're moving into those higher vols, and that's being reflected in the VIX going up technically. But has it really gone up? Well, it has in a sense. It's not lying to you. It's a higher level of VIX, but it isn't necessarily implying any sort of panic that's going on there. Now, on a day like this, when the market really takes a drubbing, I've taken an extreme example here, we see that we have not, the VIX is soaring, right? The VIX has gone from the low 20s to the 30s and 40s, right? So the VIX has definitely taken off in a very noticeable way. But what's interesting is that I want you to really understand how the curve can affect, how those fixed strike vols can really affect things. And sometimes you can look at fixed strike. So in the example of this particular curve, the market actually went down. The VIX went up only slightly, but we moved down into some higher implied levels on the skew, but the curve actually shifted down. And that was when I came out and said, you know what? We've had a couple of days of this happening. I think that's exhibiting a great deal of comfort with the current sell-off, right? We sold off later, of course, but I said we're due for a 150, 200 point rally, and that's what happened. So I didn't know we were going to rally, but I did see that the fear levels were no longer there. In fact, we were starting to see a little bit of relaxation in fixed vol. Those out of the money puts were dropping in implied volatility, even though the market was dropping a little bit as well, right? And that's not supposed to happen when people are panicking. If market makers are panicking and need a steady supply of downside protection, then they're going to be bidding those up, right? So that's kind of telling you a little bit that participants in volatility markets are not in a panic mode. They're not offside too much, meaning short tons and tons and tons of downside. They're in a relatively comfortable position that they're happy to drop their bids and absorb any supply of puts, right? If they were panicking, these fixed strike vols wouldn't be going down. They'd be pushing them up. So, people would be buying them. Market makers would be bidding up because they're offside. Maybe they're short tons of them. So that was a moment where I thought, well, that's a sign of relaxation. And sure enough, the market had a nice little comeback at that point. It wasn't to last, but that's the way it goes. So in very short time spans, we can kind of use this information to kind of see, is there extra fear in there? Or does there seem to be a squishiness to volatility, meaning there's not a lot of fear in vol, even though the market might be doing something, might be going down a little bit. But if vol isn't really reflecting that by shifting that curve up, those fixed strike vols really, really exploding or moving higher, when you see all this green, that means they're moving higher. If you see a bunch of red or, kind of black, then they're not really doing much, or they're actually falling. So try to pay attention to the market and to the VIX and how the VIX behaves. And if you do have the tools, pay attention to fixed strike vol as well. That's something that you should be looking at every day when you're a really sort of advanced options trader, volatility trader. And of course, as options traders, we're all volatility traders. So this is one of those little things that can help you to see what might be going on there, maybe help you to decide to cover some positions. If you don't see things panicking to the downside, maybe that's a sign for you to maybe sell out some puts or cover some positions, downside positions, because you're not being given that sense that things are really panicky. So hopefully you guys learned a little bit there, and we'll see you in the next one.